Hey everyone, welcome back to Corporate Decoder, the place where we, decode corporations. Today, we're diving into the Federal Home Loan Bank of Dallas, or FHLB Dallas, and their latest filing. Think of it as reading their financial diary, except way less scandalous and way more about loans. Are they making smart money moves, or are they heading for trouble? Let's find out. This report is from February 24, 2025. That means we're getting a pretty recent snapshot of what's going on with them. The heart of this report is about debt, specifically something called consolidated obligations. Basically, it's how the bank gets most of its money by selling debt securities in the capital markets. Think of it like the bank issuing its own IOUs to investors. These consolidated obligations are basically bonds and discount notes, and they're not just the responsibility of FHLB Dallas. They're the joint responsibility of all 11 federal home loan banks. So if one bank struggles, the others are on the hook too. It's a bit like a financial buddy system. The Office of Finance helps the FHL banks with selling these obligations. It's super important to understand that these consolidated obligations aren't backed by the US government. It's all on the FHL banks to make good on these debts. That's a key detail. Now, Schedule A is like a list of all the new bonds the bank is promising to issue, where FHLB Dallas is the main borrower. If they took over someone else's debt, that's in here too. One important thing. This schedule doesn't show discount notes, which are those short-term debts they use all the time. Also, it doesn't show bonds issued by the other FHL banks. Okay, let's dig into Schedule A. This is where the rubber meets the road. On February 24, 2025, they committed to issuing bonds with the CUSIP number. Well, it's a bunch of letters and numbers, but what matters is that it matures in December 2027. It's a $15 million chunk with an initial coupon rate, which is basically the interest rate, of 4.540%. The very next day, February 25, they made a few more moves. Another $40 million in similar bonds maturing in December 2027. They also have $35 million in bonds that mature way out in February 2055 with a 6% interest rate. Then they're adding $170 million in bonds maturing in March 2026 at 4.340%. And finally, $15 million in bonds due in March 2040 with a rate of 5.625%. These are also optional principal redemption bonds, and most are Bermudan. What does that mean? It means the bank can choose to pay them off early on certain dates, like they have options. Also, these bonds are fixed constant, meaning the interest rate stays the same. Now, optional principal redemption means they can pay it off early if they want. Bermudan means they can only pay it off early on certain dates. And fixed constant means that interest rate is locked in. These descriptions give us a quick cheat sheet. Conversion bonds can switch between fixed and variable rates. Fixed bonds have the same interest. Variable bonds change based on an index, so what does all this mean? Well, FHLB Dallas is actively borrowing money in the market. They're locking in different interest rates for different lengths of time. That means the bank is making bets about the future of interest rates. If they think rates will go up, they might prefer shorter-term bonds. If they think rates will stay low, they might go for longer-term bonds to lock in those rates. It's a balancing act. Sue Cassidy, Vice President and Director of Financial Reporting, signed off on this report. That means she's responsible for making sure the numbers are accurate. So here's my take on FHLB Dallas taking this report and everything into consideration. The fact that they're issuing all these bonds tells us they need cash. That's not necessarily bad, but it's something to keep an eye on. The mix of short-term and long-term bonds suggests they're trying to balance risk. However, because these consolidated obligations are the joint responsibilities of all 11 FHL banks, if one of those banks gets into trouble, it could create a domino effect. Also, FHLB Dallas doesn't operate in a vacuum. Rising interest rates could make it harder for them to borrow money in the future or might squeeze their profit margins because they have to pay more interest. Overall, the report paints a picture of a bank that's actively managing its debt. It's not a simple picture, and it requires keeping an eye on interest rates, the health of other FHL banks, and the broader economy. Thanks for watching. If you found this breakdown helpful, please hit that like button, leave a comment, and subscribe for more corporate decoding. See you next time.